Entering international markets is a complex but potentially rewarding strategy for businesses seeking growth. This process involves multiple steps and considerations that can help a company successfully expand its operations abroad. Before venturing into international markets, a business must conduct thorough research. This involves understanding the targeted country's economic landscape, cultural nuances, legal regulations, and consumer behavior. Market research is crucial to grasp what products or services will succeed. It often involves analyzing local competitors, market trends, and potential barriers to entry. Once the market is well understood, a business needs to develop an entry strategy. Common strategies include exporting, licensing, franchising, forming joint ventures, or setting up local subsidiaries. Each option has its own benefits and risks, and the choice largely depends on factors like financial resources, business nature, and the level of control a company wants to maintain over its operations. Exporting is often the first step for many businesses, as it requires less investment and allows a company to test foreign waters with minimal risk. Licensing and franchising offer opportunities to share knowledge and brand credibility in exchange for royalties without bearing the operational risks directly. Joint ventures and setting up local subsidiaries are more involved, but provide greater control and local presence. A joint venture involves partnering with a local business, which can help navigate regulatory challenges and connect with local consumers more effectively. A wholly owned subsidiary gives the highest level of control, but requires a significant investment and a deep commitment to operating in the new environment. Cultural adaptation is another critical component of successful international market entry. Businesses must tailor their products, marketing strategies, and even business practices to align with local customs and preferences. This often involves hiring local talent who understand the market intricacies and customer expectations. Legal considerations cannot be overlooked, as businesses must comply with both local and international laws. This includes understanding tax obligations, employment laws, and trade regulations that could impact operations. Engaging with legal experts who specialize in international business can provide crucial guidance. Businesses must also be prepared to handle logistical challenges such as supply chain management, currency fluctuations, and political instability. Risk management strategies should be in place to mitigate potential adverse effects on operations. Successful entry into international markets can lead to increased revenue, diversification of business risk, and enhanced brand recognition. However, it requires careful planning, strategic thinking, and a willingness to adapt and learn. By navigating these complexities conscientiously, businesses can thrive in the global marketplace,